But thank you.
Yeah, that's awesome. Well, I mean, so long as I think that you rent it out on Airbnb or short term for 14 days of the year, then you get the entire year of accelerated depreciation. So, I mean, if nothing else, that's worth it by itself. And then you go to midterm.
Yeah.
But like you said, if you could keep it and also have an exit strategy of long term and midterm and short term, then
Yeah.
man, that's a triple win. So nice going.
Yeah.
We should have you share a whole analysis on that, because short term rentals is really, it's a really powerful tool, and not a lot of people know how to analyze those deals, especially with the triple whammy win.
Yeah. So we'll let me get, a couple months in, and absolutely I can put some numbers together and make a presentation.
Yeah. Once you get your first paycheck.
Yeah.
Nice,
Cool.
nice.
Thank
nice
you.
work. Yeah.
Thank you.
All right. What's happening, Corey?
Are you ready? Well, happy Aloha Friday, everybody. Hope everybody had a productive, great week. Why don't we start with leads, needs, and good deeds? Anything?
I'll go. If I just wanna, I'm still raising capital for duplex. We started the renovations. Obviously, I had my own capital, so we needed to close and we started renovations. But I'd like to recoup my capital by offering a return for a private lender to come in for the rehab. It's about 100,000 that we need, probably for 6 months at 12%. Let me know if you're interested.
And is it here, Ted?
No, it's in Indianapolis.
India?
It's a unique duplex because they usually have, the typical like 2 units, 1 building. It's 2 permitted living dwellings on 1 lot. And then after my team went through, they told me that it was like, I guess like prefab or something. Maybe that's how they got around the permitting. But that's very rare over there. They usually have like one dwelling and then maybe a detached garage. So it's super rare that they've got 2 separate dwellings. So, and it's nice. The seller has like each, dwelling fenced in. So each property has its own little yard. So super cute. But we started demo this week. So yeah.
Perfect. So 6 months, 12%, about 100,000 you need, right?
Yep.
Perfect. Well, if anyone
Thank
can help
you.
Tay or is willing to partner up and invest out there and look at her deal, reach out.
Yeah, and we do a lot of, we've got 2 fix and flips too. I think I'm done raising capital for the fix and flip, but just in case, yeah, we've got a couple of deals. We're always raising capital. Like, what else is new? Thank you.
Yep.
Tay, do you have a executive summary you could send out for those who are interested?
Yep.
Yeah. Okay, perfect.
Yeah, got a link. I think a few people in here have gotten it.
Gotcha.
Hey, you're
Want me
crushing
to put it in the chat?
Yeah.
Yes, please.
Absolutely. Do you ever do instead of just private raise, do you ever do a joint venture where somebody comes in with Corey and I call it dequity?
Okay, so it's funny you bring this up because I've only heard of Dequity in here. And this morning I pitched a larger deal to a potential private lender, and just we went over executive summary, pictures, videos, and all of that. And I mean, he's super nice, and I did offer Dequity for that, like, so 12% return or 12% of the equity, whichever is higher. And we kind of did some quick calculations, what the potential profit could be at the end, obviously, so obviously 12% out of the profit would be a lot more for this private lender. So, but I can only do that on flips, right? I've never done joint venture for anything that I'm doing a buy and hold on. If you guys have a creative way of doing that, I'd love to learn. But on buy and holds, it's kind of like the strict APR return. Unless there's something else, I'd love to learn.
if it's long term, usually the asset's stabilized by then. So you hopefully can ride, that's your asset now or your company's asset. And then all the investors that came on the project are out, right? So yeah, for long term, it's a little harder to structure a debt equity deal. But maybe I think it's been a while, probably over a year since like I did something on raising private money and then utilizing strategies or tools like debt equity. So maybe we'll do another one like that. And I think I have after reading our last book, Go Give or Sell More, it's totally helped change a few things, and also shows like, it kind of confirmed a lot to me of what the way that we raise money is very powerful, because we're not selling, we're really not, and there's no need to sell. So I think that'll be an important topic, especially now, right, where cash is gonna be king, it seems like. So it's either cash is trash or cash is king. One of those, like, I guess it depends your circumstance. But
so that deal that I kind of pitched, the equity idea, which is it's in Indianapolis, and this is rare, but the appraisal came in over 100K higher than what we bought it at. So I was like, okay, cool. So we feel so, confident about it. Yeah, it's just between when we went into contract and closing a few more homes sold, which totally increased our APR, our ARV there, like the as is. So, kind of walking into 100K of equity, so 440-ish change of purchase and 540 appraisal, as is appraisal. So super stoked about that.
That's awesome. That's awesome. The only so Tay, the way that you could do equity on a long-term hold is when you first purchase it and you buy it, say, on a bridge, then just before refinancing is when you can use that juncture for doing the equity calculation, and then you refinance, right? So a syndication's oftentimes like that as well. So when you syndicate, you're bringing a bunch of limited partners on, you're giving them a preferred return of say 9 to 12%, and then possibly a windfall or a percentage of profit, if you will. And then what you can do is, instead of selling the asset or holding it, you're actually just refinancing it. And that's the point in which you then calculate everything out, pay them off, and then refinance it, and you keep the property long-term hold.
Okay, so this is what I was thinking, that it could work with a long-term hold, is right there, like at refi with a cash out option, then part of that cash out would go to that PML, maybe either on top of their interest or something. So okay, but I just wanted to hear it from someone who's done it before I start talking about it, and then it's like, no, that's not a good, Yeah. Okay.
It works out.
Is that what it
really
is?
well.
Kind of like the out of the cash out that I would kind of get from the refi, they could get a chunk.
Yeah, exactly. And you may notate it in your initial lender documents, is that you may choose to refi and hold the property, at which point you would pay them out and they would get a percentage of the profit at, say, appraised value, or some sort of agreement that they'll feel like it's a fair value upon which you're calculating their profit.
Perfect. Okay. Thank you.
I think Lily ran away. I see her running behind you.
I know, dude. I'm worried about our boat floating away too. So I'm constantly like, I think it's still there.
Well, Tay, yeah, sorry, I misunderstood. For a 30-year, you can still use the investor to come in on the front end and be taken out with a refi. And if there's enough equity to be pay them out with the equity structure. And since we talked about it so much, and I put up the slides, and it's only 2 slides, let me just share it so people understand what we're talking about. You guys see my slide? I always get mixed up with the double screen.
Yeah, we can see it.
Yes, go.
Okay, perfect. Okay. Oh, shoot. Sorry, it took me from the beginning. Okay, so equity is basically a strategy that combines, well, the beautiful thing about equity is if you offer that to an investor, and not every project or scenario may work with it, but most of the time it can be structured this way. But your private lender could have the security of being a debt lender with the potential upside of being an equity partner. Okay, so basically the lender will receive 3 documents: a promissory note, a mortgage in second position, and a partnership agreement to dictate the equity percentage. So the private money lender will receive the promised interest rate or agreed upon equity, whichever is higher at the end of the deal, like Tay said, right? So to calculate the equity side, though, it's a little tricky, right? So whether you offer 10% or 12%, that's up to you for on the debt side. But let's use this example. Bob invests 100 grand, right, at 12% interest. The project is expected to take 8 months and net 100,000 in profit. So based on those projections, Bob is expected to make $8,000 in his debt position, right? Because 12% on $100,000 is $1,000 per month. That's 1% per month. If it's going to take him 8 months, he stands to make $8,000, right, with that loan. So to calculate his equity position, because we're going to offer him either or, right? It's all based on projections at the beginning of the project. And to calculate the equity side, we divide the projected amount that they're supposed to make as a debt lender, which is 8,000, right? And we divide that by our projected net profit. Let's say our projected net profit was $100,000. Okay, so that's how we calculate his equity. So Bob, therefore, will receive 12% interest as a debt lender, or 8% equity of the net profits, whichever is higher at the end of the deal, right? So Tay, you might have had to have adjusted the equity side based on this calculation. That's probably why the 12% on that deal seems like too much, because it probably was too much. Do you know what I mean? So when you calculate the equity side, you first have to calculate how much are they projected to make as a debt lender at whatever interest rate you're charging or you're paying. And then take that number and divide it by your projected net profit to calculate his equity position. Then you go to the investor and say, Bob, I want to give you a equity, option. And the beautiful thing about equity is that he has the security of being a debt lender, right? With the potential upside of being an equity investor. Because if you're an equity partner, then you ride the ups and the downs, right?
Yeah, totally. So
it's debt. It has to be paid back, right?
Yeah.
So and there's collateral to that usually. When the beautiful thing about equity is that it doesn't cost you that much more, but it keeps your investor rooting for you. We want our investors to make a lot of money, and we want our investors to be happy. We want our investors to be vested in our success and our venture, right? Because they're investing in us too. So let's say, given this example, let's say it took Bob 12 months to do the project, right? And they netted, instead of 100, they netted 50 grand. The project didn't go according to plan, right? So 8% of 50 grand is less than $12,000, right? So his debt position will be higher. So if it took 12 months, then at the end of the deal, Bob will be paid $12,000. Right?
Yep.
His debt position will be worth more. Now, let's say Bob exits in 4 months and he makes 150,000, right? Then the equity side will be more. So he'll make 8% off of 150,000 in 4 months, right? So that's the power of equity. It helps investors, stay vested in your deals, right? And it doesn't cost you that much more, because if you're paying them more in the equity position, that means the project was a success, right? And that means you probably made more too. So everybody made more. So it's a powerful strategy. To my knowledge, I don't know anyone else using that strategy. So if you guys want to, dive in deeper, we can. And maybe we'll do a presentation again on raising private capital. I think there's a lot of lessons to be learned, especially now. want to position ourselves for each. Anyways,
Thank you for clarifying.
yeah, no problem. Tay, if you need help, call me and we can we can structure it. I can help you structure it
Yeah.
for him. If
I'm glad it was like in the second or third Kiko Capital meetup that I attended back in 2020 that you brought this up, and I'm glad that you did, because I guess it's a pretty unique strategy that you guys use. It's
and
amazing.
actually where I got it from was Leonard Rosen, who is one of our mentors, and he mentioned equity, that they do this with on the loan side,
Okay.
where sometimes there's correspondent strategies where some lenders partnering with another lender, so they'll bring in a small amount while another lender will bring the majority of the amount to close the loan. All this stuff happens in the background, right? So some lenders take what's called a B piece. So it's kind of like they're riding the deal too, right? So and Leonard, that's like a sort of like a equity structure. And then I was like, you know what, why don't we just do that for our lenders? Like the more we get people excited about what we're doing and like come on board and participate, like the more that we can do. So, but I'm actually, it brought a smile to my face that you felt confident enough to put it out there to an investor, like that's a big step. And
Yeah, and he's just really nice, and he wants to learn, like it's a kind of like he's got a busy 9 to 5 life, but he wants to learn. And he did say, oh, I like the equity because I feel I'll be more involved and kind of like part of the deal rather than just a silent capital partner sort of. So yeah.
Were you trying to put the Indianapolis duplex in front of him for the 100?
As well, yeah. But so I'm letting him, kind of pick and choose.
If you want to structure a Zoom with us three, I can help you with that if you would entertain it. But if he's not,
Okay. I think he's in here, but I don't know.
Okay.
But sure, I'll text him and see what he wants to do.
No
Thank
problem.
you so much, Corey.
Yeah, of course.
Thank you.
No problem. Yeah, hopefully that works out. But call me if there's any help that I can.
Yeah, I guess honestly, it maybe the terminology, I think I understand, it's whichever is higher after the final profit. It sounds pretty simple to me. But thank you.
It is a little complicated, yeah. Definitely in the beginning too, and then there's extra paperwork involved, right? The deal. But I think it should work. If you're willing to pay 12%, because that's a high interest rate. It should work, and there should be enough. If there's enough equity, even if your exit is to cash out refi, it should be enough to still cover your investment.
Yeah, this one is for sure flip. It is. It's not in an area that would cash flow as a rental. It's very much so home. What's that called? Home buy, like a private residence show area. It's 3 acres. It's like it's not your typical rental area. So it'll be a flip. It also came from friends here who had a connection in Indy, and they wanted to partner in the deal. So just like a deal, and then we're done with the deal type of situation.
Good.
Thank you.
Perfect. Awesome. Oh, you've been busy out here. Nice job.
That's why I gotta breathe. It was a tough first semester, seriously, super tough. So I gotta breathe for a bit. Thank you.
Yeah, you got it. Right on, Tay. All right, does anybody else have any leads, needs, good deeds? I gotta come prepared for these. Okay, cool. You had a good deed? You always do good deeds. You gave blood?
We're on vacation. Is that a good deed? I'm trying to inspire Tay. Trying to inspire everybody to buy an RV.
Yeah. Well, okay, right on, guys. Well, if you guys do think of something, feel free to, no shame, leave it in the chat, unmute, show your pretty face.
Dog. Oh, you're a dirty dog.
All right.
Yeah, you like it? You like
Oh,
it?
no Fortune Builders event this year. Interesting.
You like it?
Oh, really?
Which
There's
is
an
great.
investor event this weekend, someone said. or Chris Watchendorf asked, is anyone going to it this weekend?
Is it here?
It's in Colina.
Oh,
Yeah, that's Vince's event, I think. Yeah, it was a few days, right?
Yeah, is anyone going?
There might have been a couple of guys from our team going, I thought. I don't know. Maybe we gotta start our own big coffee talk conference.
The Millionaire Mindset one, I think it is.
Oh, yeah. That's
oh, that would be a cool one. If anybody goes, share some notes on it.
Oh, Roderick's going.
Question to the room. Does anybody have a deal out in, shucks, what market was that? Oh, Utah. Anybody? Okay. Well, never mind then.
We're still looking for multifamilies if anybody sees anything off market. So keep your eyes open if you're on any wholesale lists of any kind. That would be fantastic.
One thing I wanted to know is, because Hawaii's market is a little different. It's I feel we lag behind some of the major markets in the US. So if we're trying to stay ahead, I'm trying to just see what is going on. And I know we have people all over from different, even if they're in Hawaii, they might be investing in another market. I know that the other markets are taking big turns. But we haven't, I haven't felt it yet. We don't have anything on market.
Well, Hawaii has historically always been, a year or two behind any type of market crash.
Ashley, are you noticing any long days on market, listings getting stale, price reductions, that type of thing?
Yeah. Some properties for sure are definitely sitting longer. We have a couple new listings we just went live with and we're waiting to go live with because I have a specific way I like to launch a listing because I feel like it's like kind of a formula, so to speak. So I'm going back to that. And when I'm looking at the comps and I'm looking at what's on market, it's always been important, but it's even more important right now because I'll say, look, everything that's under contract is in this price range and everything that's active and on the market is above this price range. So let's just use an even 500, for example, everything that's in the 500s is under contract and it's in the same condition as everything that's listed in the 600s. And the 630, 650, 670, those are sitting. But if they price in the fives, they're under contract in a week. So a lot of people are there's this division that I'm noticing where people are just like still fighting for, the high price point market. And then you have others who just want to unload and move forward. And obviously that's going to affect the pricing come the next 30 days. Because depending on what, and the days on market for what's sitting in this example that I just went over yesterday, they're on market average 61 plus days. And that's some of them are 120 plus days. So it is shifting. I think it depends on a lot of things. Like always, does it check the boxes? Does it have the view? Does it have the lanai? Does it have the outdoor entertainment space? Plus, does it have rental income? If it still checks those boxes, it's above asking price. It's moving quickly. It's going to be hot. But there was another one. I was talking to an agent and, someone close to me, she had a super hot listing. There was 30 plus people to every open house. And there was only a couple offers, 2 offers. And most of them were at or below asking price. And then you still had those couple, like there was one that was above asking price cash because, the agents are still there. There's going to be this residual sort of effect going on where some people will still think that they need to, give up their children for a house. But But, you know, in that escrow, they're now asking for major credits. It was a 14-day cash close, but now they want 2-week extension on their due diligence. So their buyers are starting to stand their grounds. And I've noticed on a lot of properties of, no, I want to wait till I hear back from the sewer department. When before it was like, who cares? I'll pay anything above asking. Just accept my offer. I'll take it completely as is. I'll figure it out later. People are sort of like, no, we're gonna be responsible purchasers again.
Yeah, it kind of turned pretty quick too. It's probably, it's because the interest rates went up so quick. People they had to cancel mid escrow because they couldn't afford it anymore. There was, I forget how much percent of cancellations across the nation in mortgages, but that's good. That's good intel. I mean, because we got to keep a pulse on this. I think now, last night we're in the office, right, for Ashley's event, and speaking with all of the realtors there, and I what came to me is like, we can't be lazy in a market that's shifting, whether it's shifting from a buyer's market to a seller's market or seller's market to buyer's market. Like, it's not the time to be lazy. If anything, now's the time to strap up the boots and get out there and play hard. Because let's say like you're coming to market with a property you spent months working on, and you put a lot of money in there, you took a lot of risk, right? If your sales team or whoever's representing you, like, I think they should be going the extra mile. It's not even mile. I think it's just doing their job, right? Pick up the phone and call the listings that are already on market in that area and ask them how the open houses have been going. Ask them, have you been getting a lot of buyer activity? What's the feel out there? And do you have any buyers? Because maybe they're already under contract. Like, do you have any buyers for mine down the road? Because like, let's rock and roll. Like, we're going to go right now on market, but gone are the days that your agent should just put it on the MLS and then cross their fingers. You know what I mean? Like that's going to be dangerous. We need 8 players. And
on that point too, like I had a guest speaker come through, Matt Delacruz, at my team meeting on Tuesday, and he's in the mainland market in Texas. And Texas, as most people know, is a super hot market like Seattle was in Florida and Hawaii. And he spoke on what he's seeing on the mainland because he coaches realtors and stuff. And he said it's completely just flipped on those other markets where they're having to get and figure out how to get people to the open houses, even when they're priced at or below value and where the comps are at. We're not experiencing that quite here in Hawaii yet, but we definitely don't have the same traffic we used to. But he's saying that, like, in even San Antonio, for example, for the first time this month, they're like, we can't get anyone to even show up at the open houses. We're not getting any showing requests. Buyers are completely just sitting on the sidelines, just waiting to see what happens. And I thought that was really interesting feedback. Something, because Hawaii is statistically usually like a year or two behind the mainland, for us to consider when it comes to the flips that we're getting into and the appraisals. Like, appraisers, especially on your fix and flips here, at least in our market, the appraisers were always striving to hit that highest ARV. So if you said, this is the ARV I'm trying to get, they try to work that and they try to achieve that number. And I'm looking at the comps recently and I'm like, gosh, anybody that I'm working with, can you please run the deals past me first now? Because I don't see these numbers personally at all. And I don't see this I don't see this being realistic in the next 30 or 60 days either. So just be extra diligent on running very conservative ARVs moving forward. And any of your projects that are under construction right now, when you're mid-budget, just reevaluate that budget and reevaluate your ARV, because you might have a number stuck in your head. And when the time comes to list, you might be looking at something different.
Yeah, being on the mainland, we're in the Houston market as well. And 2 of our properties just fell out of escrow because of appraisals. So we are definitely seeing an impact on appraisals because appraisers are much more conservative now. And then lenders are midstream in the middle of closing, pulling out of deals. So mainland is becoming a lot rougher. There are some actual lenders who have actually closed up shop already now too. So the mainland impact is going to be pretty substantial. It's almost like a light switch went off 3 weeks ago, probably.
Yeah.
So we're seeing that a lot. A couple of things that I think we've told our clients: when you're a buyer and you're an investor, it's a great opportunity. If you're well funded and you've got the pre-approvals with a great lender, there's no hurt to make some really low ball offers, because there are some sellers who are now getting distressed because nobody's showing up. They're not getting offers. They were hoping to get some strong offers, and now they're sitting on some sort of reason to sell quickly. So get out there if you're an investor and start making some offers. If you're a seller, I'm with you, Ashley. It's like you got to do a ton more work to price it right. And every single one of our listings right now have gone stale. Most of our listings are now over 30 days. And these are fourplexes that are well priced, but investors that are new in resi multifamily, so 4 units or less, are real conservative and they're worried about a recession. So they're like, oh, we can't make any offers. So things are sitting. So again, on the investor side, great opportunity to buy. On the selling side, pricing is so important. And I don't know if there's really a good formula. I mean, the market's definitely dropping quickly.
Yeah.
But with the dropping rates, dropping economy, recession around the corner, it's a great time for real estate. So it's going to be interesting to see what happens.
Things are still moving. It's not doom and gloom. It's just get informed and be prepared. Like everything's still chugging forward. Just as it was pre-COVID, we were just in this weird anomaly for a couple of years. Like, get creative. We have a listing that's not moving, and because it's an oversaturated building, there's too much inventory. Just like a neighborhood, when you have a condo, if it's too much inventory, it sits. And so we're now marketing it because it's a VA assumable interest rate. So if, keep that in mind too, like what can we do? Right now we can sell it and they can assume the previous owner's 2.25% interest rate if they're a veteran as well. So it all comes down to know your numbers, know your market. And for the side of like taking down your deals and stuff, I think that it's a better time than ever to buy, to your point.
Yeah, got to stick to the fundamentals, Oh.
Yeah, I totally agree. But I think the other opportunity that we have in this market right now, as we come into this unknown, is seller financing. So really study up on that, and subject to, I know some of you who are, I'm subscribed to Pace Morby as well. Just the more you know on that is a great opportunity to be a solution to somebody who really needs to get out. So keep that in mind as well.
Yeah. And last night too, we were talking about the market. I just wanted to make it a point to say that the way we get out of like any shift in the market, especially one that's going down and it's going down really quick, is the way we get through it is making sure that you have the resources to sustain. For one, that's number one. You have, and that's cash, right? If you have access to capital or cash, then now's the time to start, kind of stockpiling a little bit. One, to be prepared to weather, a storm if things happen and you can't offload a property and you're paying high interest on that. You want to be able to, you want a long runway as long as you can. So if that means, starting to stack up cash, or then maybe now is the time. I don't know. You have to decide that for yourself in what position you're in. But the second thing is the way you weather any type of storm is together, on calls just like this, in the meetups that we were at late last night. Because if you run into problems or if you can't sell a property, you have to start reaching out for help, from our colleagues, and so because maybe something that's that you need help with, that's a problem for you, is an opportunity for someone on the call. Many times that's how it works. That's how the whole, I'm learning a lot about NPLs right now, non-performing loans, because that's where I see the opportunity coming. And with NPLs is, or with any investment, you have to hedge your risks. So, and I'm trying to learn as fast as I can. with the NPL side. But I know that if I can, if something were to happen and, we run into trouble, we can reach out to a lot of people in our network for help, and vice versa. They know that we can do that too. So I think these calls are important, and not just coming on the calls to get information, but participate, reach out, maybe message each other to see how you guys, if there's any symmetries to working together. Okay, cool. You got anything on your side to add?
No, I love what you just shared. In fact, I would just say, and Corey just teed up another investor just this morning on an email to me. If any of you are ever in a project or evaluating a project, or you're stuck on a project, or you're just trying to figure out something in the season ahead, not only is this entire group amazing, but if you just need someone to call right away and we can refer you to somebody in the group, just email Corey or I and just be like, hey, I've got a property I can't sell, or I'm looking at a property, can't figure it out. Seems too good to be true, or I'm worried about this property because of the recession coming. If you got anything like that you're evaluating, let us know. We'd be happy to take a look at it with you and see what we could do to help you think it through. Because I'm pretty excited about the market actually that lies ahead, but I think we're going to be better together going through it for sure.
Yep. And Tay, did you say that Kiavi went out of business too?
Yeah, that's okay. I better check. That was what this guy told me.
We're going to see, I think we're going to see a lot more going out of business. I think we're going to see some appraisers, there's going to be a lot of that.
Kiavi too. That's lending name, right?
No idea.
Wow.
There's one out of Seattle too, Corey, that just closed up. Do you remember the name of that one?
Yeah.
Bearstone's big.
Apparently not that big.
Well, the funny thing is sometimes the big guys are just way over leveraged. And so a turn like this is detrimental. And
the harder they fall, is that the saying? But I mean, like, there comes a point, like, I'm very surprised that Kiavi's had to close their doors. Like, they're massive. They're probably one of the biggest players out there. Like, but again, you're right. Like, just because you're one of the biggest, if you're not managing the leverage properly, because they were pricing so low, like people were like, oh, sorry, like we would love to work with you guys, but Kiavi is giving me like 7 and 1. We're like, okay, yeah, go over there. Like, we gotta compete with that, and but looks like maybe they didn't. Maybe that was a mistake,
I wanted to share something because I talked about it, I think it was last week, and I totally gave the wrong numbers last week on a refi that I did here on Maui. So 2021, I bought this C-class unit here on Maui, like a condo. Purchase was 110, but I paid the guys like, HARPTA, out of state tax thing, and I paid all closing costs. So I think all in, like, the purchase price was probably 120 out of my pocket, and then we put probably 15K of repairs because it's a small unit. We did the kitchen and the small bathroom. So small bathroom, small kitchen. And so because of everything else selling for $250,000 and above now in that complex, I was like, oh, there's probably equity, like I should just do a refi. So I did a refi with Bank of Hawaii. I applied in early April, so they are honoring early April rates, and that was before, I think, the spike in rates. So whatever my outstanding loan, they're gonna pay it off through this refi, and I'm getting oh gosh, where is it? 4.15%, 30 years fixed. So just that has already increased my cash flow monthly, because I was on a 20-year, but at I was on a 15-year loan at 2 point something percent with the previous lender, but still it's good. So creating cash flow there, and then I've got about 70K of equity, which I'm gonna pull out as a HELOC, 2.75% for 5 years. So under 3% for 5 years, which is still kind of good. So just going to use that to, you know, either buy more deals or maybe pay off a few private lenders, so they don't have to wait too long or whatever, you know, I'll see. So I had said something totally different last week, and in
Yeah,
case
that is
anybody was in the call, like I just wanted to, like I got the final, we're signing on Monday, and these are the
nice.
final numbers. So yeah.
Good. Good for you, Tay. That's awesome.
Woohoo,
Speaking of Bank of Hawaii, I just got the call from them because I was applying for the HELOC also. I'll actually also at Harbor Lights. And they just called me and said, "Oh, sorry, you're denied. Your DTI is 80%."
Is it 80%? Your DTI
Like,
80%? Yeah,
if my DTI was 80%, I wouldn't be eating. I would be dead already. Come on, man. Like,
That's
and,
crazy.
Yeah, they've been declining a lot of investor type of loans lately because of that. Too
well, it's
many
just
equities out and
so
stuff.
they always have had this, it's always been a challenge with that. I mean, it's a challenge like with a lot of banks, but I think Bank of Hawaii, they're one of the bigger ones, so they're a little more conservative even than others, but it basically boils down to 2 years of tax returns for every rental property you own, which means the 2 houses in Kihei that I bought in the last 12 months are both being counted against my DTI. So they're counting the $8,000 a month in debt. And that's just the mortgages, let alone the property tax, insurance, and everything. They're probably counting that too. So they're probably counting 9 or 10,000 a month in debt, but they're not counting the 19,000 a month that I collect in rent. So of course I'm gonna have like a ridiculous DTI, but yeah, it's frustrating. I'm trying to see if we can find a solution for it. Supposedly Central Pacific Bank said that they would
What are you looking
not
for, Greg? A refi?
was this is for a HELOC.
Oh, HELOC. Gotcha.
Yeah, which I probably should just do the refi because I have a HELOC and I never use it because I don't like to be in debt. So like I just don't use it. So if I should just do the refi and actually take that capital out and be ready to invest it. But again, it's just like I don't like to pay interest for capital to sit in the bank and depreciate, or suffer from inflation. So
We also gotta consider the increase in the rate if you refi.
that's why I'm getting proven wrong now. Is like, I was always so conservative about this, and when rates started to shift, that's when I should have got my stuff together. But I was under contract to buy 3 new rentals, so I couldn't go refi everything at that time. Now I'm kicking myself for not refining while rates were low, because almost everything I have would be at a higher rate if I take the equity out now. And my average LTV, I update my spreadsheet for the HELOC application, and I'm at 32% loan to value. So I'm like, have all this equity that I can't use. So I'm really kicking myself for not cash out refining sooner. But at the same time, I like to just have way more cushion than I need and all that. So it's okay. But
I think you should talk to Chris Allen anyways. He's super creative about how to structure stuff like what you're looking at. Perhaps there's something that can work with. But yeah, unfortunately the banks, that's how it goes, and that's what when I'm observing Chris do his thing. Well, you got to think about it this way. The conventional banks, if you walk into a CPB or American Savings Bank, Bank of Hawaii, and you sit in front of the loan officer or something at the desk, Chris made a good point, right? It's they don't specialize in originating loans. How can you, as the institution as a whole, when you're managing checkings accounts and savings accounts and doing car loans and all types of loans, right? But when you take it to someone, like a direct lender or someone like Chris, they can sit down with you and look at it from all angles and find, the best route to go. And even considering, current market conditions, right? Maybe you don't go straight into a 30-year fix. Maybe it's best to go into an interest only option for a few years and then have the option to refi, or I don't know. But that's something that Chris would be able to help you out with for sure, Greg.
Yeah, they also don't specialize in investors. Like if you guys keep with that policy, I would never be financeable because unless I stop
None of
buying,
us will.
I mean, at what point am I not going to have a bunch of new rentals in the last 2 years that are not on, that I don't have 2 full years of tax returns? It's not 2 years of tax returns, full years, which means it's 3 years from now that I got to wait. It's like, it's insane.
Yeah.
Yeah.
There's other options. I'm sure Chris would be more than happy to talk to you if you need. So,
Yeah, I'm here, Greg. I'm here listening. Sorry, I got my wife. She's in a big meeting right now, so I'm taking care of my 5-year-old right now. But hey, I'm gonna leave my contact in the chat, Greg, and feel free, reach out to me. You have any questions? And yeah, going back on what Corey was saying, these large banks, they don't specialize in mortgages. They do a bunch of different products, and their debt to income ratio threshold is going to be a lot higher or a lot lower than a direct lender. And so they're a lot more, they're playing it safe. They don't want to be
yeah, and it's like
they're tightening
their
their
counting
guidelines
too. That's the problem, right? Because like I just got funded on 3, like I said, I bought 3 rentals in May, and I got these 3 mortgages consecutive all at the same time. And my broker on those, I was like, hey, what's my DTI like after all this? And she's like, I'm not even gonna check it because you got so much room. Like you're like, it's like 10% DTI or something, right? And then I go to Bank of Hawaii and they're like, oh, you're 80%, get out of here, you're worthless. Like, we're not giving you any money, kid. And I'm like, you gotta be kidding me. It's just, they're so conservative, they just won't count any of this rental income, and then they're counting like more debt than they should and less income than they should. So and it just doesn't work for us.
It goes like, it's about the experience too. It's like the loan officer, an experienced loan officer that has been doing this and knows what questions to ask and what to look for to, provide accurate information up front. And not just, anybody can call a bank and say, hey, I'm looking to qualify for this. And in reality, any bank can just lie to you and say, oh yeah, we can do this, but like when it comes down to it, I tell clients, the golden question is, can they fund on the terms that they issued? You know what I mean? And that's what I've been seeing a lot lately right now, where I get a lot of clients that are coming over like, hey, we're in contract on a purchase. Our loan officer said it was a done deal. We got pre-approved, all that. And then like on the last hour, they denied them. And then I look at the file and I'm like, how are these lenders, getting these people pre-approved when in reality, it's like, there's a lot of things going on right now with debt to income ratio and, income calculation not being 100% accurate. You know what I mean? So it just, at the end of the day, it's
a lot
just
more qualifying that should be done up front. That doesn't have to
for
take
sure
a lot of effort, right? From what I watch and
sure.
you, Chris, like when you sit down with someone, you're just asking questions genuinely, and then you start to get I'm getting the big picture alongside you, just listening to your questions, listening to the answers come through. So I'm understanding the situation, and then you start to pierce like where, how we can get this done. So it definitely is a big difference of who you go to. And this includes realtors as well, in my opinion. They're, not all realtors are created equal, so just like any other profession. But yeah, maybe Greg, you sit down with Chris for a little while and you guys maybe he can help you out, hopefully.
And at least, my goal is advice over price. I want to provide accurate information, and I always strive to do that to help that individual. Whether they qualify now or they don't, doesn't mean they won't qualify next month or in 6 months. And I help create a mortgage strategy. That way they know what to do if they don't qualify. They know what to look for on tax returns and when they file tax, what income to show and et cetera, so that's where, like, I do the best I can to provide value and not just tell someone up front, oh yeah, just from what you're telling me, you qualify, without looking at the financial picture. And so, yeah, I'd be happy to help you, Greg. I'll leave my information, and you can always reach out to me if you have any questions, anything. I'm always here.
Right on. Thank you.
Yeah, right on. Thanks, Chris. Thanks, Greg. And thank you, everybody, for another great call. And on that note, just please, no shame, reach out to everybody, and let's connect, build relationships with each other, and do business, right? There's gonna be a lot of opportunities coming, I think. And we have a lot of big plans, so stay tuned, and we'll see you guys all next week. Have a great weekend. Aloha, everybody.
Hey, Corey,
Yes.